and then it does have the option for lender paid MI, so we can remove that burden from them as well. The pricing on it is pretty good as also, but it's a good vehicle to use, and then by it being conforming, there's not a inspection like FHA either.
Okay.
You know, we lean on the appraisal as our inspection guide. So as long as the appraiser goes in there, inspects the house, and does not find anything that is deemed mandatory minimum maintenance, then nothing will have to be repaired or changed or done prior to closing. So it's one of the ways that we have these two programs that's situated for these borrowers, and both programs only require a 620 middle credit score to qualify for them. And the other thing that we do, we ask for at least 3 trade lines. And they don't all have to be active, but we need to see at least one that has a 24-month history so that we can demonstrate the credit experience of the particular borrower. So we usually ask for one that's 24 months and 2 that are 12 months. If it's closed, as long as it's closed within the last 24 months, and we saw that it was paid as agreed before it closed, like some auto loans or some other installment loans they have, then we can use that as one of their qualifying trade lines in order to demonstrate that credit experience. So these are products that we have. Our home program, the other unique thing about it is that we give $4,500 up to $4,500 in closing cost assistance. And it's not a second mortgage, it's not a silent second, it doesn't have to be paid back. It's truly closing cost assistance that we provide to the borrowers to help them, cover the cost of getting into this first home. And so we've seen it a lot of times, and I think the sweet spot on that program, anytime when they're borrowing 120 or less, usually their responsibility at closing is less than $1,000. If they put down $1,000 as a binder, they may come to closing and get their appraisal money back. So we saw a lot of them where they come to close and they're actually getting checks back because we structured a loan to where that the $4,500 would cover just about all their costs. Normally, when we send out our first fee sheet to the title company, we usually try to tell the title company, hey, we're giving them $4,500 of allowable bank fees, meaning that we try to tell the title company right then, use our money first. Apply all of our money to everything that can be applied to, and then if the seller is doing something, then use the seller's money. Don't apply the seller's money first because there's only certain fees that we can pay. And when they apply the seller's money first, we can't overlap that. We can't double pay that. And so I want them to get as much of that $4,500 as possible. And so we tell them to use our money first in order to cover a lot of their closing costs for them. It does require, the only skin in the game that we require really is that appraisal cost. That's the only upfront cost that they'll do is for their appraisal. And that satisfies their skin in the game requirement, so to say, with this particular product. It's one of the better products that we have, and even in comparison to, say for instance, if you're looking at it, because this is one I had to compare last week, H2H. And so we had a borrower that was using H2H trying to purchase a house for 105, I believe it was. And then they were going to FHA, so it's that 3.5% down that they were doing, all the closing costs that they were paying, and I think she was getting $10,000 H2H. So basically, H2H only paid her down payment and her closing costs. She was still at that 105 range. Well, she came to me, we're able to do 100% finance and give you $4,500 for closing cost assistance, and there's no PMI on the product. So we're able to give her a better product that gave her a lower monthly payment, and then it was less response. So in comparison, looking at apples to apples, we were able to outmatch that because, with it, don't have mortgage insurance for the life of the loan, don't have to go through an FHA inspection, don't have to go through the city inspection, can look at some other properties that may not normally qualify for due to some little nitpicky things. So it worked out in her favor that our product ended up being a better product for her. And so it's one of those things, we've been pushing it in the market now for the last 4 years, 3.5 years. When I first got here, our product was 97%, and it took a lot of begging and fighting and fussing. I went to Houston and I acted the fool over that, and they gave us 100%. And I went back to Houston and said, we gotta get a DPA, and then they gave me the $4,500 in order for us to use. But it's all about a way for us to compete with other banks that are using the DPAs, the down payment assistance programs, and for us to have a product for them that's suitable, that's a good product, and that's easier for them to get into than a lot of other products. And again, it's only a 620 middle credit score to qualify for this particular product.
What's the DTI?
43% flat. And when we say 43%, it is 43%, not 43.00125, 43. I mean, and they're really keen about it because we want to make sure that this borrower is in a position to where that if anything were to happen, God forbid, loss of job, injury, anything else, they'll be able to maintain their responsibilities until they get back on their feet. And so that's the biggest thing about keeping them at the 43. And I say 43 is their max. Sometimes I push some of them, especially when I look at that history with some of them, and I'm like, hey, you got the best history of doing things. You may want to be at about 38 or 40%, you know, just to give you another kind of a safety net just in case anything were to happen. Especially when you look at some of the jobs, with some of them, they only been working in this job for 2 years, this profession for 2 years. There may be a change that's going to happen. So with you, I want you to stay a little lower. That way you can keep yourself out of any kind of financial ruin or trouble. And so those are the ones that we kind of coach and make sure that they're getting in the best product that'll keep them in that home.
So that's where you're saying when you're talking about trying to partner with the self-sufficiency program, that the challenge, see, because based on what Sharice is saying, that challenge may be, it may be a little bit more of a challenge when you're talking about trying to consider where that 43% lie if they're coming with a certain portion and the housing authority is coming with a certain portion. Like she's saying, how are you really looking out to determine whether or not they're going to be at that 43 or less?
Well, even looking at it, the one borrower that I was telling you about, his voucher amount or proposed amount that he's going to get, I think it's going to be like $400 a month. That really takes him to the 43% to get a house at $115,000. And so with his income, because he's on disability, so he's getting very little income from that disability, and he has some bills. He has some bill paying. He has a little car note that he's paying and some other little credit cards that he's paying. And so without that voucher, if he try to buy now, he'll be somewhere probably, we'll say $65,000.
Right.
Because everything is kind of to the max of it. But with that voucher, that's what opens up that additional in order for him to be able to purchase at a higher rate, be able to purchase more house that's more suitable for him. And so that's how we use it. But like you're saying, when we think about that 43%, you know, I hit on that a lot of times. That's why even with Mr. Simmons, me and him, we kept having that head, but about that 43%, because this is where it's at. This is it's a reason for that. You know, and I tell them all the time. A lot of times people say, "Oh no, if something happened, I'm gonna pay my mortgage." Say, nah, that ain't gonna happen, because you gotta think about it. If anything happens, you're gonna keep the lights on. You're gonna keep gas in that car. You're gonna keep food in that refrigerator. And then if you have something left, you might think about that more.
That's how they do with rent too.
That's just the same thing they do with rent. You know, and so when you look at those kind of situations, you want to make sure that the bar is not setting themselves up for ruin. And so we partner with a couple of different nonprofits. We partner with Wealth Watchers. They do a lot of good work for us. We partner with Hope for Housing, with some of our borrowers that need more counseling. And one thing that we've done with Wealth Watchers recently, we've been sending borrowers to the post-closing training. And that's been really good for them, because I get calls after. They're like, okay, now I know, you know, tell them now you done bought the house. Now these are things that you need to be mindful of, you need to be responsible for, you need to stay on top of to keep you in this home, because all of our goal is not only for you to buy a home, but for you to stay in the home. You know, I tell them it's a false premise that think the bank wants your house. We do not want your house. That's a bigger problem for us to think about or imagine. And so if anything we can do, you know, they always said an ounce of prevention is better than a pound of cure. So if anything that we can do up front in order to prevent you from going into default or any kind of financial ruin, we want to do it. That's why we partner with JAREB. We partner with you guys, because not only that, some of the bars that we end up running into, like, you know, I told you about the other guy, I want to push him to a realtor. You know, don't call me and you trying to do it on the fly. That wastes my time, and that wastes everybody's time, and it's a lot of false starts with that. You know, and I want to make sure they're with somebody that one has their best interest in mind, and so they're going to treat them as though they'll treat their son, daughter, sister, cousin, family member. They're really thinking about this borrower and this next step for this borrower and not a commission check. So that's one of the big things that we lean on. And then the other, we want to make sure that they're getting the proper counsel. I think that, you know, as a realtor myself, I was a realtor. You know, I did have Malcolm will tell you, we worked in the same office years ago. So as a realtor, as a former realtor myself, one thing that I see that a lot of borrowers or buyers lack sometimes, especially with some of these fly-by-night realtors, is someone to counsel them. Someone to really tell them, no, this is for your best, you know, and not just let them, you know, lead you around by the nose, but you're able to sit them down and have a consultation. You know, I've had a few buyers, you get in there and I'm looking at the contracts and I'm looking at some of the terms, and I'm like, did y'all talk when y'all wrote this in? When you wrote this firm closing date that it had to close by this date, or you would be paying these fees every day until you close? Did you look at this? Did you really? Did you agree to this? You know, being that I'm the second bank you done came to, so you done already lost 15 days. You know, so these are things that, you know, when I think about it, I never badmouth who the realtor is, but I make them be more introspective about what they got. But these are things that you know, has to be addressed up front and be able to make sure they're getting the best possible contract ever. And the reason being, because you all know our business, the main bit of our business is word of mouth.
Yes.
You know, and it can kill you, or it can help you thrive. You know, and being able to have those people that could go out and talk about them. I say, yeah, go tell your cousin, your auntie, everybody, let the whole family know.
Yeah.
You know, I just did a family recently. I did the